This chapter covered a lot of information. I bet your understanding of life insurance is becoming more and more clear. How about a pop quiz? What constitutes the entire contract? The insurance policy with a copy of the application and any riders and amendments. Which rider allows an insured to purchase additional coverage without evidence of insurability? Guaranteed insurability rider. What are the 3 non-forfeiture options? Cash surrender value, extended term, and reduced paid-up insurance. Did your answers match up? Before moving on, check the learning objectives established at the start of the chapter. Identify and describe common life policy provisions. Know the different types of beneficiary designations. Explain the 3 non-forfeiture options. Describe dividend options and know what types of policies offer them. Identify the various settlement options and know why each may be selected. If you feel like you need a refresher, look over the chapter again and review the points you didn't recall. When ready, move on to the next chapter.
There is no standard policy form in life insurance. However, the National Association of Insurance Commissioners, or NAIC, adopted standard policy provisions which help create uniformity among life insurance policies. These standard provisions will be tested on your licensing exam, so they are important for you to understand. Policy provisions, also referred to as clauses, are the terms and conditions that govern a policy and outline the rights and obligations of each party to the contract. Provisions define the conditions for coverage, as well as exclusions and other restrictions. Provisions are built into policies to protect either the insurance company or the insured. One standard provision is ownership rights. Whoever owns the policy controls the policy. The policy owner can name and change beneficiaries, access cash values, and take out policy loans. They can surrender the contract and even assign ownership of the contract to someone else. For the purposes of your exam, remember that whoever pays the premium is the policy owner, and the policy owner completely controls the life insurance policy. Another policy provision is assignment. There are 2 types of assignment: absolute assignment and collateral assignment. Absolute assignment gives the policy owner the right to turn full ownership and control of a life insurance policy over to someone else. For example, if a parent takes out a life policy on their child, the parent is the policy owner and the one who pays the premium. When the child reaches age 18, the parent can make an absolute assignment of ownership of the policy to the now adult child. The child is now the new policy owner who pays the premium, names the beneficiary, has access to the cash value, and can surrender or assign the policy. It is totally theirs to control, and the parent no longer has any ownership rights. With collateral assignment, the policy owner has the right to temporarily assign ownership of the policy to a third party. Suppose the policy owner needs collateral for a loan. The cash value of the life insurance policy can be used as collateral to back up the loan in case of default. During the loan period, the lender would have access to enough of the cash value to pay off an outstanding loan. At the end, when the loan is paid off, policy ownership reverts to the original policy owner. Next is the insuring clause or insuring agreement. It usually appears in the front of the policy and provides important information about the policy itself. The insuring clause names the parties to the contract. Remember, insurance policies are two-party contracts. The insurer is one party, and the policy owner or the insured is the other. The insuring clause also lists the premium amounts, the length of the coverage, and the amount of the death benefit. The insuring agreement is the company's promise to pay the benefit to the beneficiary upon receipt proof of the insured's death, subject to the terms and conditions of the policy. Remember that consideration is one of the required elements of an insurance contract. Consideration means the parties to the contract must exchange something of value. So, for the most part, consideration refers to money. For a life insurance company, the consideration is the dollar amount of the death benefit that they are contractually obligated to pay in the event of a claim. So again, the insurer's consideration is the promise to pay the death benefit. For the insured, there are two parts to consideration. The money portion is the premium payment, and the other valuable part is the complete and accurate answers provided on the life insurance application. Those answers are known as representations, which means the insured is telling the truth to the best of their knowledge. Completing the application truthfully and paying the premium represents consideration provided by the insured. The entire contract provision means that the completed application, together with the life insurance policy that was issued based on that application, constitutes the entire contract between the parties. The completed application is always attached to the issued life policy for that reason. If there are any riders or amendments to the policy, they also become part of the entire contract. Another standard provision is the free look period, or the right to examine. The free look period protects insureds. The free look period begins when the agent delivers the policy to the insured. Usually with life insurance, the free look period is 10 days. Anytime during that 10-day period, the insured may return the policy to the insurer for any reason and will be refunded 100% of any premiums paid. So again, here's what you need to remember. The free look period begins on the day of the policy delivery. It is usually 10 days, and if the policy is returned, the insurer must refund 100% of the paid premium. The grace period is another policy provision that protects the insureds. The grace period allows for a period of time during which a late premium payment may still be made without the policy lapsing. Typically, the grace period on individual life insurance policies is 30 days. For group insurance, it may be 31 days. The purpose of the grace period is to protect the policy owner from unintentionally lapsing coverage because they forgot to pay the premium and are just a few days late. Coverage continues during the grace period. If the insured dies during the grace period, the policy is still in force, so the death benefit will be paid out to the beneficiary. The insurance company, however, has the right to subtract the amount of the unpaid premiums from the proceeds, but otherwise, they must pay the death benefit. First is incontestability. The incontestability clause is usually in effect for the first 2 years of a life insurance policy. During the 2-year period, if an insurance company discovers that an insured submitted material misrepresentations on the application or concealed information that would have been important for the underwriters to know in order to make a proper decision about the risk, the company may void the contract and would not be obligated to pay on any claims. This helps the insurance company avoid adverse selection by eliminating bad risks who are seeking insurance coverage by intentionally being untruthful on the application. After 2 years, however, the insurer cannot use the material misrepresentation defense to deny coverage. One exception to this provision is statements relating to the age or gender of the insured. Those misrepresentations can be contested even after the 2-year period because age and gender are critical factors in life insurance underwriting. And, as you would guess, incontestability does not apply to non-payment of premiums. Anytime the premium is not paid by the end of the grace period, that could cause the policy to lapse. The incontestability period does not protect against that. We just mentioned the insured's age and gender, and there is a provision called misstatement of age or gender. If a proposed insured misrepresented their age, gender, or identity on a life insurance application, the insurer may not even learn about this until the time of the claim when, for example, the death certificate confirms that the insured was several years older than what was stated on the application. The insurance company issued the policy under different assumptions about the insured's longevity and probably charged a lower premium because of that assumption. So once the misstatement of age is discovered, the insurer has the right to adjust the death benefit to what the insured would have purchased if they had been truthful about their age. The insurer cannot just void the policy, but again, they can adjust the benefit based on the correct information. Reinstatement. Every insurance company must include a reinstatement provision in its policies. Reinstatement means putting a lapsed policy back in force, and there is a specified time limit to do that, usually 3 years after the lapse. Now, why would someone want to reinstate a lapsed policy instead of buying a new one? The advantage of that is that the reinstated policy will be based on the original issue age and might offer features and benefits not otherwise available in newer policies. The insurance company is not required to reinstate a lapsed policy, and they can establish requirements that must be met in order for an insured to qualify for reinstatement. Most often, the insured must complete a reinstatement application and pay all overdue premiums plus interest. If there were loans taken out on the original policy, those loans must be repaid with interest. And finally, the insured may have to provide proof of insurability by answering medical questions or undergoing a physical exam. Note, however, that if a policy has been surrendered, it cannot be reinstated. Let's recap the standard policy provisions. Understand that these were standardized by the National Association of Insurance Commissioners, or NAIC, but they may vary by state. Provisions are built into policies to either protect the insurance company or the insured. Standard policy provisions include the owner's rights, assignment, entire contract, insuring clause, free look, consideration, reinstatement, incontestability period, misstatement of age or gender, and payment of premiums. There may be additional provisions explained in your course based on your state requirements, so make sure you review all of them. Exclusions. When something is excluded from an insurance policy, it means there is no coverage. In life insurance, there are 3 major exclusions. The first one is aviation, referring to non-commercial aviation. For example, if an insured is a private pilot that flies small planes, Any deaths related to non commercial flights will not be covered by a life insurance policy. Another exclusion in life insurance is the hazardous occupation or a hazardous hobby exclusion. If the insured participates in dangerous hobbies like skydiving, bungee jumping, or scuba diving, those types of activities may be excluded from coverage. This is why it is so important for the insured to answer the questions on the application truthfully. Similarly, there are certain occupations that are just too risky for a life insurance company to underwrite. For example, race car drivers or participants in extreme sports competitions might require specialized coverage because deaths from those types of activities will be excluded. The third exclusion is war and military service. There is no coverage for death due to an act of war or if the insured dies during military service. Of course, the military may provide death benefits for military personnel, but a personally owned life insurance policy will exclude these types of losses. It's important for producers to understand and be able to explain these exclusions to customers who may be impacted by them. Although not an exclusion per se, the suicide clause in life insurance policies specifies the initial time period during which the death benefit will not be paid if the insured dies by suicide. It is similar to the incontestability clause in that it applies only to the first couple of years of the contract. In most states, it's a 2-year period, but some states limit it to 1 year. Make sure to check the state requirements in your course. If a person buys a life insurance policy and then dies by suicide within the first 2 years, the insurance company will not pay out the death benefit and will only return the premiums paid to the beneficiary. If the death occurs more than 2 years after the policy has been in effect, then the insurance company would pay the full death benefit to the beneficiary. So why 2 years? Well, if someone dies by suicide within 2 years of taking out a life insurance policy, it could be reasonably concluded that the policy was purchased because suicide was intended or planned. If that happened more than 2 years after the policy issue, it is less likely to have anything to do with the purchase of life insurance. So remember, the 3 types of exclusions in life insurance policies: non-commercial aviation, hazardous occupations or hobbies, and war and military service. And then there is the initial time period during which the death benefit will not be paid if the insured's death is a result of a suicide. In life insurance policies, a beneficiary is a person or an entity that received the death benefit in the event of the insured's death. There are several different ways to name or designate beneficiaries. First of all, the insured can name individual beneficiaries, a spouse, a child, or a relative. Individual designations are very common. Note that if a child of the insured is named as the beneficiary and the child is a minor, the benefits cannot be paid to the child until the child reaches maturity. The way to designate minor children to receive death benefits is to set up a trust and name a trustee to act on behalf of the child with instructions to manage the assets until the child is eligible for the benefits. Another way to name beneficiaries is by class. Class simply means a group of people. So the insured may choose to say all of my children equally, so that the death benefit will be equally divided between the children of the insured. Even if the insured has only one child when the policy is issued, but may be planning to have more in the future, when the insured dies, all of their children at that time will be paid in equal shares. An insured can also designate their estate as a beneficiary. The insurance policy is an asset that is owned by the insured at the time of death and becomes part of the estate. If no beneficiaries are named in the policy, the insured's estate will automatically receive the proceeds of a life insurance policy. Another way to classify beneficiaries is by who gets paid first. Many insureds designate just one person who would be considered the primary beneficiary. The primary beneficiary is the first person the insurance company will reach out to, assuming that person is still alive. The primary beneficiary will receive the death benefit paid to them federal income tax free because they are listed as the primary beneficiary. An insured may also designate contingent beneficiaries, sometimes called secondary, meaning beneficiaries who will receive the death benefit if the primary beneficiary has died or cannot otherwise be found. There is another important way to classify beneficiary designations as revocable or irrevocable. The majority of beneficiary designations are revocable, meaning they can be changed at any time by the policy owner. Think about it this way: their right as the beneficiary can be revoked at any time. Occasionally, the beneficiary may be listed as irrevocable, meaning the designation is permanent and cannot be changed. For example, this may happen as part of a divorce proceeding in order to provide financial protection for a former spouse or minor children of the insured. An irrevocable designation may not be changed without the written consent of the beneficiary. Irrevocable beneficiaries have a vested interest in the policy, and therefore the policy owner may not exercise certain rights without the beneficiary's consent. It is important for insurance producers to make sure that the insureds and their beneficiaries' information in the policy is up to date. From time to time, they may need to ask their clients if they want to make any changes. Has the insured got married, got divorced, or had children? Have any of the named beneficiaries died? All of these may require a change in named beneficiaries to protect the insured's wishes and the rights of the survivors. Policy loans. The first thing to remember about policy loans is that they are only available from policies that accumulate cash values, so from permanent insurance policies only. Term policies do not offer policy loans because there is no cash value accumulation. Remember, term insurance is pure insurance protection. So, what are the types of permanent cash value insurance policies? It will be whole life policies, universal policies, and variable policies, to name the major types. On a whole life policy, for example, the maximum loan available would be equal to the cash value of the policy. The loan accrues small amounts of interest, and it does not have to be paid back during the insured's lifetime. Usually, insureds who take out loans against the cash value of their life policies don't intend to pay the loans back during their lifetime. However, if the loan is outstanding at the time of the insured's death, the loan amount plus interest will be subtracted from the death benefit. When an insured requests a policy loan, the insurance company has up to 6 months to provide the loan amount to the insured from the cash values. Another great feature of cash value policies is the automatic premium loan. It protects the insured by preventing unintentional lapse of policy. It is always a good idea to request the automatic premium loan option on every life policy that offers it. If the insured forgets or is unable to pay the premium when due, the insurer may take the amount due from the policy's cash value and apply it toward the premium to keep the policy in force and prevent a lapse. This still counts as a policy loan, so the loan amount with interest will be subtracted from the net death benefit paid to the beneficiary. Know that loan requests for payment of due premiums must be honored immediately. Partial surrender or withdrawal. Those terms only apply to universal life policies and are very similar to taking a loan against the cash value. The insurance company may allow a partial surrender or withdrawal from a universal life insurance policy, and the insured may be charged for exercising these options. There are limits as to how much the policy will allow an insured to take out. Typically, an insured may not access the full cash value, and any interest charged may be taxable. Policy writers modify the existing policy and its provisions and are usually used to increase or decrease policy benefits or premiums. Some riders require an additional premium. There are several common riders that provide benefits in the event of the insured's disability. Let's focus on them now. Probably one of the most popular and most often used disability riders is the waiver of premium rider. It can be added at a small cost, but it can really be of huge benefit to the insured. If the insured becomes totally disabled and cannot return to work and pay the insurance coverage premium, the waiver of premium rider will help to keep the coverage in force. Proof of total disability will be required, and the insurer may impose a 6-month waiting period from the time of the disability until the first premium is waived. So the insured is responsible for paying the premium for the first 6 months of disability. However, if the disability continues beyond the 6 months, those premiums would be reimbursed and any future premiums will continue to be waived for the entire period of total disability. There are additional disability riders that are specific to certain products. For example, the waiver of cost of insurance rider applies only to universal life or interest-sensitive whole life policies. This rider waives the cost of insurance and other expenses, so not the entire premium. If the insured wants to continue to grow the cash value in the policy, they will need to continue paying the portion of the premium necessary to accumulate cash values. Another special disability rider, similar to the waiver of cost insurance, is the waiver of monthly deductions, which only applies to universal life or variable universal life policies. Monthly deductions include the actual cost of the insurance charges, expense charges, and cost or charges for any benefits added to the policy by the rider. This rider waives those monthly deductions only, so again, not the entire premium, and also has a 6-month waiting period. Then there is the payer benefit rider, which only applies to one kind of policy, and that's the juvenile policy. If the insured, as a parent or even a grandparent, takes out a life insurance policy on a child, the premium payer is the adult and not the insured child. This rider provides for payment of the premiums on the juvenile policy in the event the payer becomes disabled or dies. It will continue to waive the policy premiums until the end of the payer's disability, or if the payer dies, until the child officially becomes an adult. One more disability rider you need to know about is the disability income rider. In essence, it is the same as purchasing a disability income policy. A disability income policy replaces the insured's lost income due to a disability. This protection can be attached as a rider to a life insurance policy. It's fairly expensive, but it waives the policy premiums during a period of disability and pays a monthly wage to replace some of the insured's lost income. The amount of income replacement provided is calculated as a percentage of the death benefit of the policy. For example, the policy has a $100,000 death benefit, and there is a 20% payout defined by the disability income rider. The maximum benefit that will be paid in lost wages would be $20,000. After the monthly benefits reach that amount in total, the rider would stop paying income benefits. There are special riders that can be used to cover additional insureds on the same policy, usually family members. These riders are referred to as a family term. For example, an insured who is the main wage earner in the family takes out a life insurance policy. The insured can then add life insurance coverage for the spouse and children through a rider added to that policy, usually for an additional cost. If the rider covers just the spouse of the insured, it can be specified as a spouse term rider and allows the spouse to be added to coverage for a limited period of time, so it usually expires when the spouse reaches age 65. Similarly, if the insured wants to cover only children, the children's term rider may be used. This coverage is also term insurance and usually expires when the child reaches a certain age, such as 18 or 21. Note that all of the children of the insured are covered under this rider for one premium, so the premium will not change if additional children are included. So to summarize, to cover other insureds or additional insureds, a level term rider can be added to the insured's base policy. There are riders that may affect the death benefit paid out to the beneficiary by either increasing or decreasing the face amount of the policy. Let's go over those riders. First, let's look at the riders that may increase the death benefit. One rider that may provide a higher death benefit is the accidental death and dismemberment rider, or AD&D. The AD&D is a form of accident insurance that is attached to a life insurance policy. The accidental death portion will pay out in multiples of the face amount, usually double or triple. The covered death must be the direct result of an accident and must occur within 90 days of the accident. The principal sum is what is paid out as the death benefit. For example, an insured has purchased a life policy with a $100,000 death benefit and has added a double indemnity AD&D rider. If the insured dies as a result of a covered accident, the policy will pay out a $200,000 principal sum to the beneficiary, the $100,000 death benefit times 2. With a triple indemnity AD&D rider, the policy would pay out $300,000. If the insured suffers an accidental dismemberment by losing a leg, an arm, a foot, or a hand, then what is paid is called the capital sum, which is usually a percentage of the policy's face value. For example, 50%. For an insured with a $100,000 life policy carrying an AD&D rider at 50%, the accidental loss of a limb would result in a $50,000 payout to the insured. Another rider that may increase the amount of the death benefit is the guaranteed insurability rider, which allows the insured to add coverage at specified future dates or events. For example, every 5 years, or if the insured has a child. The insured does not have to provide evidence of insurability when they increase coverage, but they will have to pay an additional premium. Since the amount of coverage goes up, the premium goes up as well. The guaranteed insurability rider might make most sense for an insured who is worried because there is a family history of cancer or some other life-threatening disease. The insured may be healthy when purchasing the life insurance policy, but may become uninsurable in a few years because of their health condition, so this rider guarantees insurability with future increases in coverage. This rider usually expires at the insured's age of 40. Next is the cost of living rider. It addresses the inflation factor by automatically increasing the amount of insurance, and the insured does not have to provide insurability. The face amount of the policy increases by a cost of living factor tied to an inflation index, such as the Consumer Price Index, CPI. There is one more rider that, while it does not increase the death benefit, it offers an additional payout feature for the insured. The return of premium rider can be purchased with a term life policy and will refund the premiums paid into the policy to the insured if still living at the end of the policy term. The policy then expires and the coverage ends. If the insured dies during the policy period, the beneficiary will receive just the death benefit, just like in any other life insurance policy. So to recap, the riders that increase the death benefit are the accidental death and dismemberment rider, or AD&D, the guaranteed insurability rider, and the cost of living rider. The return of premium rider refunds the premiums to the insured at the end of the policy term. Now let's take a look at a rider that will decrease the amount of death benefit if used. That rider is called the Accelerated or Living Benefits Rider. It provides early access to the death benefit in order to help the insured paid for catastrophic medical bills or long-term care. Because this rider is simply an advance payment of the death benefit, it is usually added at no additional cost. The amount paid to the insured will reduce the death benefit paid to the beneficiary after the insured's death. This rider would be helpful to an insured who becomes terminally ill and is expected to die within 2 years, or someone who requires permanent confinement to a nursing home or needs long-term care. Now let's learn about non-forfeiture options. An important thing to remember is that non-forfeiture options only apply to permanent life insurance, not term insurance. Because permanent life insurance policies have cash values, certain guarantees are built into the policy, stipulating that the policy owner will not forfeit or lose the value of the policy if the policy is surrendered or lapses. There are 3 non-forfeiture options available to policy owners: cash surrender, extended term, and reduced paid-up insurance. For the purpose of the explanation provided below, let's assume that the policy owner is also the insured. Suppose an insured decides they no longer need their whole life policy or cannot afford the premiums anymore. The insured can surrender the policy and receive its current cash value. So this first non-forfeiture option is called a cash surrender option. Some of the money received will not be taxable, the premiums paid into the policy. If the cash value exceeds the premiums paid, the excess will be taxable as ordinary income. Once the policy is surrendered, the insured is no longer covered. Another option is the extended term option. The insured could use the cash value in the whole life policy to purchase an annually renewable term policy that would provide ongoing death protections with the same death benefit amount. Suppose the insured had a $50,000 whole life policy. With the extended term option, the insured could purchase a $50,000 term policy with premiums being paid from the cash value in the original policy. Under the extended term option, it would be possible for the insured to outlive the term protection because the cash value will eventually be exhausted and the policy will terminate. For your exam, you also need to know that if the policy owner does not select one of the non-forfeiture options, the insurer will automatically implement the extended term option when the policy is terminated. The last non forfeiture option is called reduced paid up insurance. With this option, the policy owner uses the cash value of the original policy to purchase a paid up permanent policy with a smaller death benefit, whatever the cash value can buy. Think of it as using the cash value to purchase a single premium whole life policy. This policy will build its own cash value and remain in force until the insured reaches age 100 or dies. Know that the insurer is required to include in each permanent policy a table of non-forfeiture values for a minimum period of 20 years. Let's take a look at a sample table of those guaranteed values and how they can be applied to each non-forfeiture option. Suppose the insured has a $50,000 whole life policy that they decide to surrender after 15 years. The policy cash surrender value at the end of year 15 is $8,100. If the insured chooses the cash surrender option, they will be paid $8,100, some of which may be taxable if it exceeds the amount of premiums paid. If the insured chooses the reduced paid up option, the policy's cash value of $8,100 will buy a new whole life policy with the death benefit of $21,750. The new policy will be completely paid up and will potentially continue in force until the insured's age of 100. Finally, if the insured chooses the extended term option, the $8,100 cash value will purchase a $50,000 term policy that will last for 18 years and 8 days, after which there will be no coverage in force. An exam question may ask, which non-forfeiture option will result in the longest coverage? The answer will be reduced paid up because the coverage will last until the insured's age 100. Another question may be, which option provides the insured with the highest death benefit? In that case, the answer would be extended term because it will match the death benefit of the original policy. To recap, non-forfeiture options are available in permanent life insurance only to protect the cash values that the policy owner is entitled to. There are 3 non-forfeiture options: cash surrender, extended term, and reduced paid-up insurance. Extended term is the automatic option, and it provides the highest death benefit. Reduced paid-up option allows the policy owner to purchase a new permanent policy and provides the longest coverage. Non-forfeiture options are exercised when the policy is surrendered or lapses. Dividend options. Dividend options are only available in participating policies, which are policies issued by mutual insurance companies. Dividends are considered a refund of excess premiums that were paid and therefore are not taxable. It's very important to remember that dividends are never guaranteed, but when the mutual insurance company declares a dividend, the insured gets to choose how dividends are paid. The first dividend option is cash payment. If the insured chooses this option, the insurance company will send them a check for the amount of the dividend, and that amount will not be taxable. The insured may also direct the company to use the dividend to reduce the policy premiums for the following year, which is known as the reduction of premium payments option. For example, an insured has a $1,000 annual premium, and the insurance company has just declared a dividend of $100. If the reduction of premium payments option is exercised, the insured will only have to pay $900 in premiums the following year. Another dividend option is the accumulation at interest, which allows the dividends to remain in the insured's account with the insurance company, earning interest over time. Once those dividends are paid out, the dividend portion will not be taxable, but the interest portion is always taxable. The next dividend option is paid up additions. The dividends may be used to purchase additional amounts of the death benefit. Let's say an insured has a participating policy with a face amount of $100,000, and there are enough dividends declared to buy an additional $5,000 worth of insurance. So, the dividend can be used to increase the face amount from $100,000 to $105,000. Note that if the policy owner did not choose the dividend option, the insurer will automatically use paid up additions to increase the death benefit of the original policy by the amount the dividend will buy. The dividend can also be used to pay up the existing policy early. That's the paid up insurance option. The insured may first choose to accumulate the dividends at interest and then will use the accumulated dividends, interest, and policy's cash value to pay up the policy early instead of, say, continuing to pay premiums to age 100. The last dividend option is the 1-year term option. The insured may instruct the insurer to apply the dividends to purchase a 1-year term policy, which would increase the insured's overall death benefit. So remember, dividend options are available in participating insurance policies, which are issued by mutual insurance companies. The insured can take the dividend as a cash payment, use it to reduce premiums, let it accumulate with interest with the insurance company, use it to increase the policy death benefit, or to pay up the policy early, or use it to purchase a 1-year term policy. Settlement options are methods used to pay the death benefit to the beneficiary upon the insured's death or to pay the policy benefits to the policy owner at policy maturity. In other words, settlement options are triggered by the insured's death or age 100. Usually, it's the policy owner who selects a settlement option, and that selection cannot be changed by the beneficiary. However, if the policy owner does not select a settlement option, the beneficiary will be allowed to choose one at the time of the insured's death. The first payout option is a lump sum or one-time cash payment to the beneficiary. A $100,000 life policy will pay out $100,000. If the policy owner did not choose a settlement option for their life insurance policy, the insurer will automatically pay the death benefit to the beneficiary in a single cash payment. Another settlement option is life income or straight life. This option guarantees the beneficiary an income for life. The amount of each installment will be based on the beneficiary's life expectancy and the amount of the principal. With this settlement option, the beneficiary could ultimately receive more than the death benefit if they live long enough. On the other hand, the balance of the death benefit may be forfeited to the insurer if the beneficiary dies before the proceeds are exhausted. But again, the life income settlement option gives the beneficiary the security of an income for life. This settlement option can also be applied to more than one beneficiary, which is called the life income joint and survivor option, and will guarantee income for the life of 2 or more beneficiaries. Most contracts provide that the surviving recipient will receive a reduced payment after the first recipient dies, such as a half or two-thirds. For example, the insured wants to protect his elderly parents in case he dies before them. He chooses the life income joint and half survivor settlement option for his parents. Let's say the total benefit after the insured's death is $3,000 a month. The joint and half survivor option means that as long as both parents are living, they will be receiving $3,000 a month. However, when one of the parents dies, the surviving parent will continue receiving payments for as long as they live, but the benefit will only be $1,500 a month, or half of the original benefit. The next settlement option is interest only. This settlement option is designed to be temporary while more permanent decisions are being made. For example, right after the insured's death, it may be too difficult for the beneficiary to make big financial decisions, so the beneficiary may choose to allow the policy proceeds to remain with the insurer while they receive interest payments at a specific interest rate. It can also be used when the insured wants to have interest to be paid to the surviving spouse while the principal sum is being reserved for the children when they reach a certain age or at the death of the surviving spouse. There are two additional settlement options. One is fixed period installments, and the other is fixed amount installments. Whenever a beneficiary chooses this type of payout, either the number of years or the dollar amount that's paid out will be fixed. With both options, there is no guarantee that the payments will last for the life of the beneficiary, but there is a guarantee that all of the policy proceeds will be paid out. Suppose a beneficiary is going to receive a $100,000 death benefit. If the beneficiary chooses a fixed period installment option and decides that they want payments for 10 years, the death benefit will be evenly distributed over the next 10 years. So the beneficiary will receive $10,000 a year, $100,000 death benefit divided by 10 years. If the beneficiary is still alive after 10 years, the income from the policy will end. If the beneficiary dies before the end of 10 years, the proceeds will continue for the remainder of the 10-year period to a contingent beneficiary or to the primary beneficiary's estate. With the fixed period option, the longer the period selected, the smaller each installment will be. If instead the beneficiary chooses fixed amount installments and specified that they want to receive $20,000 a year, the death benefit will only be available for 5 years, $100,000 divided by $20,000. With this option, the size of each installment determines how long the benefits will be received. The larger the installments, the shorter the income period. An easy way to remember settlement options is using the acronym CLIF. C stands for cash payment, L is for life income, I is for interest only, and the two F's are for fixed period and fixed amount.